Hi, welcome to Search for Yields, the weekly newsletter from INR Bonds. I'm Arjun Patsati. And in this week's Search for Yields, we are going to talk about how the Fed rate hikes affect your bond investments or fixed income investments. Now, the US Federal Reserve, which is the central bank of the United States of America, and also the largest central bank and the most powerful central bank in the world, because the US dollar is the world's reserve currency. And whatever the Fed does has a bearing on global markets, largely because of the fact that it transmits its action into the prices of US dollars, and this affects capital flows across the world. And the US Federal Reserve has started to hike interest rates. They hiked it by 0.25% or 25 basis points yesterday. And they have said that they're going to hike it by another 6 times more this year and another 3 times next year. And this is largely due to the fact that US inflation is at 4-decade highs of 7.9%. And while the Fed is maintaining that it will cool off, then they don't want to be caught wrong-footed if inflation does not cool off. And also the fact that the US Federal Reserve is now having one of the largest balance, has the largest balance sheet in the world at USD 9 trillion. And this has been because the Fed has been buying bonds, the US Treasury from the market. And this is adding to the liquidity, and that is stock of money in the economy, which is again leading to inflation. And so even they have to now start to look to reduce the size of the balance sheets to make sure that there is no excess money sloshing around, which is leading to higher inflation in the economy. So how does this whole US Federal Reserve or the Fed move affect fixed income investors in India? And more importantly, how does it affect your investments? Now, the first thing is that inflation is at very high levels, and one of the benchmarks for global bond markets is the yield on the US 10-year Treasury, which is the equivalent to the 10-year GSEC in India, and the yield has gone up to 2.25% after the Fed rate hike, and this has gone up from 0.4% just post the COVID. So clearly, the 10-year yields are, then the US yields are largely factoring in higher inflation ahead, and there will be more rate hikes to come going forward. Now, this is also going to filter down to Indian markets. Even in India, the 10-year GSEC yield has moved up from 5.85% to closer to 6.8 to 6.9%. And a very sharp rise. And when GSEC yields rise, then what happens is the prices of bonds in the economy falls. And when the prices falls, how it affects you is that if you are invested, for example, in Bharat bond ETF or in a government bond or in a corporate bond or in fixed income mutual fund, then if the yields also on these go up, then your prices do fall and the returns also fall substantially when prices fall. So if you earn very less returns in a mutual fund, for example, then it's due to the fact that the yields have risen because of higher inflation expectations going forward. But if you are in a fixed deposit, nothing is going to happen. And only thing is that you're earning so low. The only good that even if nothing happens, you're still making losses because inflation is much higher than what you're earning in fixed deposits. And so, but one good factor is that if interest rates rise in India, then fixed deposit rates do move up, and you might earn higher in fixed deposits and in your short-term investments. So basically, if you're invested in bonds, bond yields also tend to move up. But having said that, if you are invested in bonds that are anyway earning a higher interest rate for you, then you might not see, you might even see the very stable prices for these bonds, because even if government bond yields and AAA corporate bond yields move up. Such higher yields on bonds, which are rated lower than AAA, may not move up. In fact, may even come down. And we have seen many bonds like that, their yields have actually come down, even if, and prices have gone up, even though the GSEC prices have gone down. And this is because of the fact that investors are hungry for yields, and because inflation is high and fixed deposit rates are low, and the GSEC yields are rising, and they're seeing NAVs fall in mutual funds, so they are investing in higher yielding bonds. However, higher yielding bonds do carry higher risk as well, and the investors have to be very comfortable with the issuer or the bond they invest in. But yeah, in another way, this can also work against an investor if, because of Fed rate hikes and higher inflation and Indian interest rates too high rise, and the currency gets affected because of capital outflows due to global risk aversion, then the economy falls, then lower rated credits which are offering higher yields on bonds may find business conditions getting tougher, and their rating may start to go down, or the perception in the bond markets would believe that the credit risk of these issuers in your bond terminology would actually start to come down, and so they would demand higher yields or lower prices for the bonds. So that could affect, but that remains to be seen going forward. The second is that another factor is that because of rising interest rates, the first impact is always on higher, longer maturity bonds, or infra advisory or mutual fund terminology, longer duration funds or bonds. They would see much lower returns than shorter duration bonds or funds. And so if you're investing in long duration bonds, which are say over 5 years of maturity, you might see the returns come falling very sharply. And even shorter duration bonds too, returns will fall very sharply if RBI starts to hike rates fast, because rates are at very record low levels, and short duration bonds or short maturity bonds yields are very low. And if they tend to rise also faster, then those also could affect your investments negatively. So these are all some of the aspects of how a Fed rate hike can affect your fixed income investments. And INR bonds has got some of the best bonds and the best analysis for where to invest and which bonds to invest in times when Fed rate hike happen and RBI also hikes rates, and interest rates are moving up and bond prices are falling down. They can even protect their portfolios by investing in bonds curated by INR bonds. Download the QuickInvest app by INR bonds for Android and iOS users. See the best bonds available and go through a straight-through investment process with the best information available. Financial advisors and investors alike can use this app to select the best bonds for their portfolios. Thank you very much for listening in. Do not forget to subscribe to our YouTube channel if you have not done so, and do hit like button if you appreciate our search for these. Thank you very much.